Welcome, welcome. Always my favorite part, Shannon, when folks start to make their way in.
I know, it's so exciting, right?
There's coffee in the back of the room. Sit wherever you'd like. Those the old days, that's what these used to be like.
I know. And then get people coming in late from subway stopped running.
Yeah, goodness. Lots of folks making their way in. Love to see that. Love to see that.
Yeah, we got a great response from this for this webinar, so I think we should have a lot of people coming on.
Perfect. Most wonderful time of the year-end planning season. But it's hard to believe we're only 2 weeks away from Thanksgiving. Time's running out for some of this stuff. I'm glad we're talking about it today.
I know, it's crazy. I can't believe it. Now, are you still kind of crazy with year-end stuff, or has it calmed down a little bit since
We've got about another week or two of meetings, basically, kind of wrapping up a lot of this fun year-end tax planning stuff, and then things kind of quiet down a little bit in December, where we try to limit our December meetings just to put out fires. And most folks get real busy. We find that they don't want to meet December either because it's that fun. Oh my goodness, I have a week to get my shopping done.
Yeah, right. Yeah, sometimes we have like the people trying to get in and like, oh, like after like before the new year.
Mhm. Yeah, we close down that week, which is my favorite weeks out of the year.
But yeah, yeah.
But
I feel like a lot of people are like, oh, I told myself I was gonna get my will done this year. Now it's
this year,
it's the end of the year. I haven't done anything.
oh my goodness. Oh.
And then the New Year resolution, folks.
New Year's resolution, absolutely. Yeah,
Mm-hmm.
yeah. So first week of January is always the best, the one you want to avoid at the gym, in my opinion. I've learned that's the one you don't want to go to the gym that week. It's chaos.
Yeah.
I try my best to avoid the gym 52 weeks out of the year. No, I'm just
kidding. Regardless. Okay, why don't we get started? And I think we'll probably have some folks straggling in, but we can, I think for those who are here, want to honor your time. And also, if you guys want to just put in the chat, if you have particular issues or items that that you want us to cover, that you have questions about, if you want to just put that in the chat, that could be helpful. So when we're going through things that we can address those, and it'll just be good to see what people have particular interests in. I think the big thing this year is the tax changes and the upcoming tax changes, or possibly the upcoming tax changes. The bill hasn't been passed yet. So, so there's just been a lot of talk about that, and I think that's what a lot of folks have questions about and probably are interested in. That bill is still before Congress. We're going to go over the current status of that, what changes have been made, but we don't have the final draft, if anything, because it's very possible that the Democrats won't get their acts together to do anything. So we'll see. It looks like something will pass, but yeah, there's no promises, and we're not sure what the final bill is going to look like. But we will take you through all of those, sort of what's been proposed, what's currently in there, and then some things that, if there's any changes that you feel like you should make before in anticipation of that. Okay. Anyone, any particular issues? Moving states, that's actually a really great question. Multiple states, childcare costs, healthcare. Yeah, so I think in the last few years, we've had a lot of people moving. At least that's been my experience for my clients that have been in New York. They may be temporarily leaving and then coming back, or they may be leaving for good. Um, so we will touch on that. Actually, John, if you have anything to say on that right now,
Yeah,
in
yeah.
terms of like that issue, it's
That's
not really in
probably
your
a
presentation,
multi
but I think,
yeah, that's probably a multi-webinar series in and of itself.
yeah.
We are seeing a lot of residency audits come through for folks that have left New York, and so um, there New York State residency is a very complicated issue to break in New York State domicile. Um, and so it is something that we see from time to time, and they are going to take a very aggressive approach with it because there's a lot of revenue on the table for the state of New York, as folks as folks have left during COVID, and the degree to which they've left, I would say. Have they truly left? Did they leave somewhere, land somewhere? Are they going to stay that place? And it's been described to me by some of the folks that actually deal with this on a day-to-day basis. The lawyers who do residency audits constantly say that the auditors have 20/20 hindsight. And so it's a very interesting topic. And you need to basically dot your I's and cross all your T's if you're going to make a move like that, because New York is like a clingy ex, we call it to our clients, that kind of won't leave you alone. You can't just simply pack up your bags and leave and not come back.
What exactly is the test? It's not like so many days in New York.
It's not as cut and dry as like states like California. And so there's a residency test and there's a domiciliatory test. And where a lot of people get caught is that they leave New York, but they haven't broken their domicile, and so they haven't truly left New York and landed somewhere new. So imagine you leave New York, and you spend some time hopping around Airbnbs from Tennessee to Indiana to California for a little bit, and then as the world kind of reopens post COVID, you say, well, I really want to get back to Brooklyn, and get back there. A lot of times the state of New York will view that as, well, you didn't really go somewhere and establish your life there. You just kind of hopped around a little bit and now you came back. And so you've been in New York domiciliary the whole time. And so, that is a common issue. And the question that comes in now is, ironically, we moved from California and arrived in New York. That has some very complicated tax issues, especially if you have equity compensation. And so that's something we deal with all the time as well for our clients, because it's a very complex issue the way both New York and California treat equity for people who leave.
Yeah, and you just want to make sure that you're proactive. So if you are moving states, then you want to get ahead of that probably with your accountant or your financial advisor and talk to them about what the implications are and if there are things you can do before you move or after you move to make your tax situation a little bit better. Another question that we had, so California to New York, one high tax state to another.
Yes, exactly.
Welcome. Um, Another question about IRAs and trust management, how the new laws will affect that. We will be addressing that during the presentation, so that's something that we will get to. Okay, anything else, John, that you want to add before we get started?
No, I think we should dive in. I think we're going to cover a lot of the stuff that folks have on their minds, and welcome folks to
Okay.
drop in more questions as we go.
Great, sounds good. Okay, so just to kind of get started, I'm Shannon McNulty. I'm a tax and estate planning attorney. I work with a lot of young professionals starting out their families. We also do a lot of work with international clients. I'm the author of The Complete Guide to Legal Planning for New York Parents. So if you have any questions about trusts, wills, it's a great resource. And if you are on this call, I'm happy to send you a copy of that book. So just drop me an email and we'll send that book out to you. and my email address is shannon@mcnulty-law.com. Um, let's see. So John is joining us, and he is a lead planner for Brooklyn FI, which stands for Financial Independence, I understand. John is a certified financial planner, enrolled agent, equity compensation associate, certified private wealth advisor. So lots of titles after John's name. But Brooklyn FI, do you want to tell us a little bit about Brooklyn FI, John?
Absolutely, absolutely. And so Brooklyn FI is a fee-only financial planning, investment management, and tax firm. And we're based in Brooklyn. We have team members and clients actually all over the country. We're fully remote and virtual. And so we work with a lot of clients that have equity compensation, complicated tax issues. And most of our clients are, younger professionals, Gen X, Gen Y clients who come to us because their financial life is changing. It's getting more complicated. Maybe their company's going public. Maybe they've just made a move across the country. They took a new job, and they want to partner with somebody that can not only do their personal financial planning, but can also prepare their tax returns, can also help them manage their equity compensation, can also manage their investment portfolio and do all that stuff under one roof. And so, we're in a very unique position, and we've partnered with Shannon for quite a while, and you've done a great job helping out our clients, and so thankful to have the opportunity to be on here today.
Yeah, it's great. It's really nice when we have like a whole team working together. Okay, so we're going to start off with sort of standard year-end financial planning advice that we give, sort of like, let's just put aside the sort of elephant in the room, the big tax law that's sitting on Congress's desk, and just look at what do we normally do for year-end planning, because this still hasn't gone away. We still want to pay attention to these things. So John, you want to tell us a little bit about what you types of steps that people can take to minimize their taxes and make their tax position better at the end of the year?
Absolutely, absolutely. And so I think there's several kind of standard financial planning items that we want to be thinking about as we get closer to year end, and kind of view this as a little bit of a checklist. And so one is IRA contributions. And so for most taxpayers that have earned income, they can contribute $6,000 per spouse, and you can even make a spousal IRA contribution. So if one spouse works, the other spouse doesn't, as long as there's enough income, you can both do the $6,000 max. Now, whether you're eligible to contribute to a Roth IRA, whether you're eligible to deduct that IRA contribution, it just depends on your overall income tax situation and whether you have a 401k through work. But these are great planning tools, and they are the first step in the backdoor Roth process. And we're going to talk a little bit about backdoor Roths momentarily, because they might be going away. Maxing out your
And
401k.
so the IRA,
sure.
so the IRAs are limited by income, correct? Kind of just give us some background of this. So like you can't put money into an IRA unless you have under a certain amount of income, generally.
So anybody with earned income can contribute to an IRA. It just depends, a traditional IRA, just depends on whether you're able to deduct that contribution on your tax return and get an immediate tax benefit. And so for many taxpayers, likely many of those that are on our call here today, their income might be too high to get an immediate tax benefit for that. But anybody with earned income can contribute to an IRA right now. And so this is
there
why.
any benefit to doing that if it can't be deducted?
There is, if you can do something called a backdoor Roth. And a backdoor Roth contribution is where you make a non-deductible IRA contribution. So you put $6,000 into an IRA that you did not deduct. So you didn't get an income tax benefit by putting it in, and then you subsequently convert that $6,000 to Roth. It's not as simple as it sounds, because there are very special rules, and the IRS doesn't look at one IRA for you by itself. It aggregates all of your IRAs together. And so the backdoor Roth strategy typically only works for folks that don't have other IRA money. So all their other pre-tax retirement savings is in their 401k plan, for example, and not sitting out in an IRA, or else that would really taint the backdoor Roth strategy. And so for many folks, if they wanted to do a backdoor Roth and they had the tax situation that would allow that, they'd want to get that done before the end of the year here in 2021, because that loophole could be closing.
Okay, great. Okay, so other things, sort of typical, max out your 401k
Mhm.
contributions, and you can
Couple more
check and see.
paychecks. Yeah,
Yeah.
a couple more paychecks left in the year. So you want to take advantage of that. Do you need to bump it up to hit the 19,500? We just learned late last week that that contribution limit's going up next year. So it should be 20,500 starting in 2022. So you can put a little bit more away next year.
Okay, great. And I just want to go back a little bit because I think we have a couple of people on here who are interested in this like backdoor IRA, Roth
Absolutely.
IRA kind of thing, transaction. But it sounds like this is not something, I don't really get the feeling that this is something you should just do on your own, that
Correct.
you
Correct.
probably
It's
need
like,
want some help with that because there are a lot of technical rules that it's
mhm.
really important to follow. And if you don't follow them, then it's going to, uh, it could possibly put you in a worse, even worse sort of
Exactly,
tax
exactly.
situation.
Yeah, no, it happens. And the challenge that you run into is that the major custodians out there, the Vanguard, the Fidelities of the world, like they don't really understand the strategy very well. And so a lot of times we, might have had, clients whose tax returns we prepared that said they did backdoor Roths in the past. And then we look at their documents come tax season and we're evaluating it. And we find out, well, you did something, but it wasn't a backdoor Roth contribution. And now you have a tax bill on an additional $6,000 in income. And so, yeah, it's a very nuanced strategy. You got to be very careful with it. And, if somebody knows how to execute it and has been able to do it, and they're going to do it for 2021, they should do it sooner rather than later because this loophole could close by the end of the year. Um, we did get a good question about the 401k as well, and that is if it's per spouse or per couple. The 401k $19,500 limit is on a per person basis for folks that are covered by a 401k plan. The caveat is that you need to have access to a 401k through work. And so, unlike the IRA, where let's say one spouse works, the other spouse doesn't, the the uh, both can contribute to an IRA. With the 401k, you need to actually have one through your employer.
Okay, great. Yeah, so if there's a parent who's staying at home and they don't have any income themselves, they can still contribute to the IRA, correct?
As long
So if
as their
that's
spouse
something,
has income, earned income, so wages.
okay. And is there a limit to their spouse's income is that still subject to those limitation rules?
Nope, there's no limit on the ability to contribute. The limits come into place as to whether you're actually able to deduct that contribution or get
Yeah,
a
I guess
tax
that's what
benefit for it.
I'm kind
Yeah,
of getting at
yeah.
is like
So
so
there
that
there
they
is
get
for
the
that, yes.
deduction. There's still okay. Okay. Okay, the next one, this is my favorite one actually, and I know there are a lot of parents on this call, so definitely listen up. The 529 contribution. So I'm always hammering on this because
Mhm.
in New York especially, I feel like it's a huge benefit. So John, would you want to tell us about how that works?
Yeah, yeah. New York has a fairly generous 529 plan. So nysaves.org, you can participate in the plan, and you can deduct up to $5,000 per spouse on your New York State income tax return. So $10,000 per couple in contributions. And so if you figure, let's say that your bracket's about 10% on the state level, it's going to save you about $1,000 in taxes to contribute $10,000 to this plan, which is really advantageous. And so if you have kids, if you're planning to have kids, you contribute to this before you even have kids. You can save money in a tax advantage fund um, for education and get a deduction on your New York State tax return.
Great, yeah. And then that when the ones that you kind of get two almost like a double dip, which it's kind of rare, I feel like in the tax world of you're getting both the deduction and then that money grows tax free. So
Correct.
it's really powerful. We do have a question about what is the benefit of contributing to a 529 versus a traditional IRA? And
Yeah,
I've seen that question before. You want to address that
absolutely.
issue?
That's a great question. I think it really determines really is based on what is the money for. IRA money cannot be taken out before age 59 and a half, except for some very limited exceptions to that. So that's really money that's earmarked for retirement. 529 money, in order to access it without a tax penalty, needs to be spent on qualified educational expenses. And for the New York plan, that's for college in particular. Other states' plans have some flexibility about K-12 education up to $10,000 a year. But it really depends on what's the goal that we're saving. What are we saving for here?
Yeah, so I think what I have seen is that sometimes people will ask about putting money into a Roth IRA, and then you could take that money, you could take kind of like the amount contributed, you can take out the earnings, but you can take the amount contributed out later without it being taxed. Um, is there, I guess, if we do that, you don't get the deduction at the state level. I
So
don't know if there's
yeah,
any other.
but I don't typically recommend tapping into a Roth IRA for education costs. Roth IRA money is growing tax-free. And so you really want to get that tax-free compounding for as long as you can. So you typically don't want to be tapping into that. Maybe you're in your 40s, early 50s, the kids are going off to college, but you're not going to retire for another 10 years. And so why not get that tax-free growth instead, and in that retirement style account, and save for college. And so it's being mindful of how we don't intermix different goals into the same bucket in these tax advantage accounts.
Okay, that's a really good point. And yeah, and I think that one of the points is that, well, we can do both, right? You can
Mhm.
ideally you have enough money to do both, but
Mhm.
but you kind of can contribute to max out the benefits from your IRA, but also put money into the 529 account.
Yeah, absolutely. Absolutely. And I mean, I've worked with a lot of retirees and soon to be retirees. And one piece of advice I always give them is, don't bankrupt your retirement for funding education. Education is incredibly important. I'm a big advocate of it. We want to save for it, but also be mindful of the fact that we don't want that to come at the expense of you being able to actually retire someday.
Yeah, I think, and I think that that's a conundrum that a lot of parents find themselves in, and I think one of the things is that you can borrow for education, you can't borrow for your retirement. So if you run out of money for your retirement, you're really in a bad situation. But if there's not enough money for education, there is usually some way to get those funds.
Mhm. Absolutely.
Okay, charitable gifting.
Yep. It's getting close to the end of the year. There's a couple ways you can get a tax benefit for charitable gifting. Um, the first one is available to everybody. That's $300 per spouse that can be deducted whether you itemize your deductions or not. Um, so that's a new deduction that's there this year. So 600 for a married couple, 300 for individual folks. But the bigger charitable benefit comes in when you're itemizing. And so this is where you need to kind of understand, what does your tax situation look like? Are you taking the standard deduction, which is about 12,500 for single folks, about 25,000 for married couples? Or are you itemizing your deductions because you've got 10,000 in taxes, 20,000 in mortgage interest, and you already give $3,000 a year to your YMCA, and so you're itemizing already. And so we want to think about charitable gifting first of all with, what is our goal? What are we trying to achieve? And then from there, how do we gift in the most efficient way possible? Should we gift stock instead of cash? Is there a stock that we have or a fund that we have that's done very well? And should we use that, or
Sorry.
no problem? Or should we give cash? And when should we time that gift? Is it better to give on New Year's Eve or January 1st of 2022 instead, based on what your tax situation is going to look like?
And I think it's worth bringing up as well that kind of the strategies in terms of, or the effect of charitable giving has changed in the last few years,
Mhm.
in terms of, like, if you're giving below a certain amount, you're not really going to benefit from that
Mhm.
deduction. But if you give give what we say, like, bunching the deductions or
Yep.
bunching the contributions, that could be more beneficial. Can you give us a little bit of insight on that?
Yeah. Yeah. So for many folks, because the tax cuts in 2017 limited deduction of state and local taxes and increased the standard deduction, what we have happened is that many fewer taxpayers are itemizing. Fewer taxpayers are itemizing than they did previously. And so what you want to do is understand, what's your charitable goal. So let's say your charitable goal is to give $10,000 a year for the next 5 years, and understanding that if you're not itemizing and taking the standard deduction, you might not get any benefit in each of those years by doing the 10,000 each year. And so what we might do is say, what if we gave $50,000 this year to a donor advised fund, which is kind of like it's a charitable account basically, where you can hand out the money a little bit each year over the next several years to the charities of your choice. So we get the tax deduction today, the write-off today, and take advantage of the fact that you gave 50,000 rather than not getting a benefit because maybe that 10,000 doesn't get you over the threshold for itemizing in each of the next 5 years. And so we can lump that contribution and optimize your charitable gifting, and then you can still hand it out to charity over a multi-year period.
Yeah, and I think, kind of going through and hearing you talk about all of this, it just really kind of reinforces to me like all of the value that can be added. I don't want to like make this into a commercial for Brooklyn FI, but but there are just so many moving parts, and if you're really not keeping up with, it's hard, if this isn't your job, it's just really hard to keep up with all of the changes that are constantly going on. And again, these small things that can make a really big difference of thousands and thousands of dollars.
Absolutely. Yeah. It's about building those efficiencies where we can get them. And especially as they've eliminated a lot of the tax deductions that are available, you need to take advantage of the ones that you can get today. And so no, that's a great point.
Yeah, and especially working with someone like you and Brooklyn FI that does the tax returns as well. So they're really getting into all of the tax deductions and the ways that they can minimize your taxes and strategize for the best outcome for you. And often, I mean, it's not cheap, but I feel like, you save, it's not that hard to save the amount of money that you're going to be paying. So
Yeah, I like to look at financial planning. It's an investment, and it's understanding that in some years there's strategies that can save $50,000 or $100,000 in taxes or optimize your situation that way. And in other years, I kind of think about tax planning as the joke that I use is pieces of Swiss cheese. And so if you layer enough pieces of Swiss cheese on top of each other, you can eventually not see through because of all the little holes in it. And so that's really what tax planning is in many respects. How do we layer a variety of different strategies in place, not to make your tax bill disappear? I don't have I don't have a magic wand to make that happen, but to make it more and more efficient over time.
Okay, great. Okay, next one. This is really an estate planning one, the annual gifting. This is really if you have substantial assets. There's a gift tax exclusion of $15,000 per donee, per recipient. And a lot of times people get this confused that they think that if you go over that amount, you're going to have to pay gift tax on it. That's not exactly how it works. It just means that it counts whatever is over the $15,000 counts against your lifetime exemption of whether it's 6 million or 11.7 million right now. So, just don't be too eager to be gifting away the $15,000. When does this make sense? Usually for older people. So this might be a great time to or a great strategy to ask your parents. You want to save money and give me a gift of $15,000 at the end of the year. But yeah, so just good to know those rules. And again, only really if you have substantial assets or you're older, do I feel like this makes a lot of sense.
Absolutely.
Okay, tax loss harvesting. Harvesting. This is always, I feel like, a little bit confusing. So
this is a little dense. I hope everybody's sitting down. But yes, and so tax loss harvesting, basically. So let's say, for example, Shannon, let's say at the beginning of the year you bought a small cap value fund. Or let's make it even simpler. Let's say you bought stock in Apple. And let's say, for example, Apple stock in that year, which doesn't happen too often, but let's say in that year, Apple stock drops 10%. And so let's say you put $100,000 into Apple and now it's worth $90,000. Not that I recommend buying individual equities, but just for the sake of the example. And so you have a loss of $10,000 there, but it's unrealized because you haven't sold the Apple stock yet. And so what happens is, but maybe you have some other investments that have capital gains that year, and you can really use that loss from Apple. And so what you can do is you can go in there and you can sell off your Apple stock to get that $10,000 loss, and offset some of your gains. But there's a special rule here that says you can't go back and buy Apple stock again for another 30 days, without triggering what's called a wash sale. And so there's special rules around wash sales that basically says if you buy the stock again right away, you're still in the same position, so you don't get to deduct that loss. But maybe you say, well, I don't have Apple stock anymore. I don't have Apple stock anymore. So why don't instead I take that $90,000 I get after I sold it off and buy Microsoft stock? Microsoft's a different company. It's in the same space, but it is a different security altogether. And so you could do that as part of your tax loss harvesting. You can swap out the Vanguard Total Stock Market Index for the Vanguard S&P 500 Index, as part of tax loss harvesting. And so those are some of the strategies that we want to look at, especially for folks that have significant capital gain income. Maybe you've gone through a liquidity event. Maybe your company went public. You stole a bunch of stock options, whatever it might be. We want to be mindful of the fact that, in a diversified portfolio, not everything should be going in the exact same direction all the time. And so there might be losses. How do we take them to optimize your tax situation?
Okay, great. Thanks, John, for that. Okay, so there's a couple of questions that came in I just want to address, because they do sort of touch on some of these things that we talked about. Any change for those who are over 50 getting an increase in their 401k contributions?
I believe the catch-up contribution is still $6,500 next year. I don't think that's changed. Just the regular contribution is going up.
Okay, great. So there is a contribution, a catch-up contribution for
Available.
those who are 50 or over,
Mhm.
but I don't think that's going to be changing. It's just
Correct.
the same that it was before.
Correct.
Okay, great. Standard year-end legal planning. So this is also just a good time to review your estate plan. Has anything changed? Have you had a new baby? Then you want to update your documents for that. Has anything changed with respect to the individuals you've named in your document? So who you've chosen as your guardian or your alternate power of attorney or something like that? Have that person moved away, or maybe they've gotten sick and somebody has passed away? Then those are things that we definitely want to address to update your documents. Also, this is a really big one that I try to hammer on a lot, is this like ancillary planning. So a lot of people think like, okay, I'm just gonna go get a will and then their estate planning is done. So it's not done. That's only really like the first phase of your planning. Updating beneficiary designations, funding any living trusts, making sure that you have kind of like practical guidance on who's holding the documents, who knows about them, what would happen if, God forbid, something happened to you. We want all of those things taken care of so that you basically have like a plan that is definitely going to work when you need it. These are things that we help our clients with. We don't really let them go unless like we have all of these things in place. But if you work with another lawyer, these might be some things that have been missed. So you want to make sure that they are taken care of, because otherwise kind of all of that money that you just paid to do a fancy trust, it's not going to do what it's supposed to do when the time comes. Okay, gifting. This is something that we just talked about on the previous slide of the $15,000. Like I mentioned, really only if you have substantial assets, and in that case, you probably want to be working with either a financial advisor or an estate planning attorney to guide you on when that's appropriate to be making those gifts, and to whom, and in what form. So one thing that I see a big mistake a lot of times people make is they're putting money away into like an UTMA account, a minor's account, and saying, okay, I'm using my $15,000 a year. And so now I have for my child like $100,000 for their education. The thing is that you can't use that money however you want. In fact, you really can't use it for much at all. The child has to use it. So you really can't touch it. And if that child, when they turn 21, they are on the party circuit and they're not really looking to go to college, or they're like, well, that's what the 529 money is for. Why should I use it for this when I really want to get a new car? So whatever situation they're in, that money goes to them, and they could have an alcohol issue, they could have a substance abuse issue. So I really don't recommend putting money into an UTMA account for your children. If you want to do like small amounts, like a couple $100s, or their money that they're earning from babysitting or something like that, go right ahead. But for substantial amounts of money, there are other ways and better ways to save and put money aside for your kids. Last thing, your parents' planning. So this is something that it's not your own planning, but it's something that's definitely going to affect you. And it's more even likely because as people get older, they're going to get more infirm, and I hope, eventually they'll pass. And all of those things are issues that you're going to be dealing with. So please talk to them about making sure that their planning is in place. And if there's anything that we've kind of learned for these last couple years, it's that we really don't know what's going to happen. And hopefully your parents that can be a little bit of a incentive for them to get their planning done. I know that even like when COVID hit, I was like a nervous wreck about where are the documents, the way I prepare for my parents, just making sure that we had them on hand, because you don't want to be in a situation where it's last minute and you're hustling, and we just couldn't get things done the way that we would have previously. So just make sure that's done ahead of time, because otherwise it's just going to end up being a problem for you. Okay, so let's get to what's in the news. This is what's in the current bill in terms of individual taxation, at least the things that we think are going to affect, will be likely to affect people who are on this call. We're not addressing like corporate taxation. There's very complicated rules about foreign income, but we are addressing sort of some of the big things that affect individual taxpayers. Okay, so this first one, we'll start off with good news, because
Maybe.
most of this we're talking about tax increases, but let's talk about possibly a tax benefit, John. And this is just to clarify, this is what's in the current bill, not been passed yet, but this is the framework that's currently under discussion, so to speak. So what's this first one?
Yeah, so right now we have in the current bill an increase to the state and local tax deduction, or SALT taxes, as we like to call it in the industry. So right now, for both married couples and individuals, you can only deduct $10,000 in state and local taxes on your federal income tax return. And so if you live in New York, which I'm assuming most of our attendees live in the state of New York, well, it's pretty easy to get to $10,000 in state and local taxes between property taxes, estate taxes, city taxes here in New York City, all of those things. Add them all up. Many folks, that gets you easily over $10,000, but you've been capped at $10,000 in deductions on that for the last several years. And so one of the things that this bill does is that it increases that deduction cap from $10,000 to $72,500 starting in 2021. Now, we'll see if they do this. I think this is probably one of the least progressive features of this tax bill. And so it's certainly something that could be on the chopping block that could get adjusted.
But it's very good for progressive states. So.
Yeah, interestingly enough, it's very good for the bluer states. It is, who tend to have higher state and local taxes. But yes, this would be a big change. It would have a lot more folks itemizing their tax deductions, again, that have not previously been itemizing because of the limit. And so we're going to keep a close eye on this. What I would say is that there's talk of adjusting the alternative minimum tax, which is could be a whole separate webinar to account for this. And so while many folks might, in theory, get this deduction if they pass it, the government might just get it back in the form of a different tax called the alternative minimum tax. And so it'll be interesting to watch how that plays out.
Okay, great. Okay, next one. This is really a big one for anyone who has stock in a small company, a startup founder, or you work for a startup. John, you want to tell us about this qualified small business stock, the
Yes.
change to those rules?
Absolutely. So yes, this is qualified small business stock, or QSBS. It's a carve out in the tax code that's really designed to help incentivize people to invest in small businesses when they're small. In early stage startups, that kind of thing. And basically, how it works is that if you, depending on your timing, if you did that, if you held the stock for more than 5 years, if it's the right type of company, if you got it directly when the company was, if you were the initial holder of that, you didn't buy it on a secondary market. And the company's in the right trade or business, there's certain industries that are excluded from this, then you could potentially exclude up to $10 million in capital gains on the stock from your income, which is a great deal. And it's been around for several years. It's always been up to 10 million in gain, but the percentage that you can exclude has varied over time. And so it was initially 50%. They bumped up to 75% at one point. In the last several years, post Great Recession, it's been about 100% exclusion. And so one of the things they want to do is for folks who make more than $450,000 a year, they can bump this exclusion down to 50%. Well, if you're selling off $10 million in stock, then you obviously are making a lot more than $450,000 a year. And so for many folks, the exclusion for qualified small business stock may be reduced dramatically. And this is one of the features that's in the bill currently, Shannon, that's retroactive. So there's not much proactive planning to do right now because this takes effect as of September 14th, 2021. And so for a lot of these capital gains and timing-based things, they make the date of effect the date of introduction so that folks don't go close a bunch of transactions between now and the end of the year to kind of work around it.
Yeah, and that's another kind of reminder of why we want to stay ahead of these things. So sometimes by the time the legislation is introduced, it's already too late to take advantage of some of these things.
Absolutely.
Okay, this is a big one. I think we had a couple of questions on it. The closing of the backdoor Roth and mega backdoor Roth loophole.
Yeah. So I talked
We
a
like
little
to
bit.
call them tax planning opportunities.
Yes. Tax planning opportunities, not loopholes. Yeah, it's not a loophole. I mean, Congress is very well aware that this is part of the tax code currently. But yeah, so the backdoor Roth, which we talked about a little bit before, is basically allowing you to get $6,000 a year into a Roth IRA that you wouldn't otherwise be eligible to contribute. The mega backdoor Roth for certain companies, this is a unique carve out in the 401k plan that allows folks to contribute another up to $38,500 to a Roth account on a tax-free basis annually. So obviously, a great planning opportunity to get tax-free growth, because to take a step back, remember the benefit of a Roth is that you don't pay tax on all the appreciation in the account. And so the current legislation that we see closes this loophole. And so I know we had a question about an attendee asking about the mega backdoor Roth. If this passes, you will no longer be able to employ that strategy. And so one of the things to keep in mind as we approach year end is that if you are doing this strategy and you are making what is called after-tax 401k contributions, you want to make sure you get those funds converted before the end of the year. Because if you have a final contribution that goes in on your December 31st paycheck as after tax and needs to get converted, the custodian, Fidelity, Vanguard, whoever it might not be able to convert it in time before this law takes effect. And so we've been telling a lot of clients to try to max out this strategy if they're doing it by their mid-December paycheck, so it logistically can actually happen and be done before the end of the year.
So this is one of the things that this is still an opportunity that people can still benefit from this.
And they should probably, if they're using the strategy currently, they should check in on it and make sure that it's in line to get everything done this year. Because what you don't want to have happen is have a bunch of after-tax money sitting in your 401k that you can't convert to anything. It's kind of be an unfortunate outcome there.
Okay. And just a couple of questions have come in about the QSBS industries that are included, excluded. I think that they're traditionally, like any tech companies, are included.
Typically, financial
lawyers,
services are not included.
Financial services, law firms, I'm pretty sure are not included.
Professional services,
Any kind of services, businesses are
Yeah.
often excluded, but I'm not sure I'm sure you can find that if you.
Yeah, it's a fairly nuanced thing. And so, and a lot of companies blur those lines. What if you're a fintech company? Are you a tech company? Or are you a finance company? And so oftentimes we need to, talk to tax attorneys, talk to, accountants to get opinions about that, or even get private letter rulings from the IRS to determine whether a business is eligible. And it's certainly something worth spending a few bucks on to get that opinion if it can exclude, millions of dollars in gains from your taxes. That a full QSBS exclusion under the current law before it changes could save you upwards of $3.5 to $4 million in taxes, which is a huge deal. So.
Another question, and this is a common question I get, especially now as we feel like college is maybe not going to be the same in the future as it is now, or as it has been really in this past century, in terms of what it's sort of the road to a better quality of life, higher incomes. But college might look very different, or education may look very different in 10, 20 years.
Absolutely.
And this has come up here, somebody has raised it, but I have heard a lot of other people raise it as well, is it still makes sense to contribute to a 529 plan if your kids may not end up going to college?
Yeah. And I think it's a tricky question, because you have this scenario where education will likely look very different 18 years from now. What is it going to cost? Is it going to be free? Is the system going to look different? But I think the thing to keep in mind with 529 accounts is they've gotten a lot more flexible in recent years. So you can put it towards, in part, towards private K-12 education, not the New York plan, but other state plans. You can use it for not just tuition and fees, but also room and board and some of the supplies. And if, going into the specific example of what if my kid doesn't end up going to college, there's no requirement you take the money out of the 529 account. So you can leave it in there. You can use it for other children, grandchildren in the future, other relatives in the family if they want to go to school. Let's say, your oldest child, goes off to a military academy where they don't have to pay tuition. But then your other child goes, to a private 4-year institution and goes off to med school and has lots of education expenses. You can change beneficiaries there. And so we still think it's a very valuable tool to employ to get that tax-free growth for those education costs. And for many taxpayers, it's the only game in town in terms of, a means to get a benefit, because you don't get the credits that are out there for education costs if your income's too high. And so I definitely think that it's still a valuable opportunity, but we want to be mindful of how do we balance the 529 opposed to other ways to save longer term for children's education.
And if it comes out, it's taxed, what is it? The income is taxed an additional 10%. Is that
correct? So
it's not used for qualified expenses.
Correct. So the money that you put in will not be taxed, but if you take a withdrawal for non-education costs, it's taxed at regular income tax rates plus 10% on the growth. The other thing to keep in mind, though, is there are some exclusions to that. So one of them is, let's say your kid gets a scholarship and gets a full ride, and let's say the scholarship's worth $40,000 a year, then you can take $40,000 a year out of the 529 account without paying a penalty. You will still pay tax on the growth at regular income, but you won't pay that 10% penalty on the amount of the scholarship.
So, okay. Yeah. So you're already kind of getting, the benefit of the tax-free growth as well. So, I don't even know that you'll end up being that penalized in terms of if that doesn't work out in terms of your child not going to college.
Absolutely.
Okay. Next one. Okay. So here are some, okay. Oh yeah. We still have more on this.
I was gonna say, I think we just have a few quick hitters here, though, Shannon, that probably don't apply to a ton of folks. So I'm happy to just kind of run through them. And so, it looks like we only sent the email address to the host and panelist. And I think that's why.
Okay.
But yeah, and so there's a couple other provisions. One is taxing S Corp owners on their income if they make more than $400,000 a year. So right now, an S Corp on the federal level is a very tax advantage way to earn money if you're a small business owner. For that, that is not necessarily the most advantageous way to structure your business if you're in New York and New York City, but it is an advantage way for many folks. And so they are going to kind of take a jab at those owners that are high earners of S corps and tax the income at additional 3.8%. And then for really high earners, for folks that have more than $10 million in income, they're going to see a surtax that kicks in at 5%. 5% starting at the income above 10 million, and at 25 million in income, it's going to be another 3% on top of that. And that's a little bit. The income threshold for that is much lower on trust. It starts at $100,000 in income for trusts. And
so this is where I just wanted to say there was a question that came up. So a lot of people don't fall into the $10 million in income. So you're in a good situation if you do, but this sort of income, the surtax on trust income can hit more people. This starts at $100,000. So if you have trust income over $100,000, then you're going to be hit with a 5%. And I think then it's like $200,000 goes to 8%. I can't remember the exact dollar amount, but the key here is to manage the trust properly. So if you are a beneficiary of a trust, then you want to make sure, check in with the trustee about these taxes and whether the trust is going to get hit with them. Generally, it's just a matter of managing the trust. So, it makes the calculus in terms of like, do we distribute money from the trust? Do we keep money in the trust? Different. So you just want to be aware of that and work with your trustee and your trust advisors on making sure that the trust is managed properly. A lot of other types of trust that we do, like irrevocable life insurance trusts, it's not going to affect those at all. Only these, what we call non-grantor trusts. So if you do have a lot of trust in your family, then you just want to make sure that you're aware of these things and that whoever's advising you is giving you the proper advice. And we might want to change, sort of push more money out of the trust than you would have previously. Hope that was helpful.
Absolutely.
Okay, additional changes in the original bill that were not included that basically are on the cutting room floor now. It's possible some of these can be brought back. We don't expect that they will be, but John, you want to kind of just take us quickly through that? And then we have a question. We have somebody's hand up, so I want to get to that, but why don't you just take us through this quickly?
Yeah, absolutely. And so they talked about raising the top tax bracket up to 39.6. That was the top rate a little while back. Before the Trump tax cuts were passed. They talked about raising capital gains rates. They talked about taxing incomes not at the $10 million level, but at the $5 million level. And so they've increased that in the current form. That can always change. They want to go after some of the estate planning stuff as well that Shannon deals with. And so touching the adjustment in basis, the estate tax exemption, and some of the different trusts that they have out there. And then similarly, the unrealized gains of billionaires was another piece that they had kind of thrown in there. And so there's lots of ideas that have been thrown around. And I think the general tone and tenor of the conversation is that the tax environment is getting less favorable on a federal level. And so we need to be very mindful of that. We want to think about what is the low-hanging fruit in this uncertain period that we can take advantage of now, knowing that next year, the tax situation for most folks, with the exception of maybe that state and local tax section, will likely be a little bit worse. There will be, tighter loopholes. There may be some higher rates in certain instances and just a less favorable overall environment. That's the message that we're getting in this legislation. And so one of the things that I've spent a lot of time thinking about, Shannon, is just what can we do now that we're not going to be kicking ourselves in February if this doesn't pass for doing, but has then a little downside, but a lot of upside if this does come through. And so those are some of the items that I think we have on our next slide here that address that.
Okay.
And so wrapping up your backdoor Roth conversion, considering accelerating ordinary income if you're going to be in the top tax bracket and always be in that top tax bracket. And so that's for folks that make over $600,000 a year. in most cases. And so there's something to be said for that. In certain occasions, deferring deductions to 2022. If bracket's going to be higher next year, we might want to push off some deductions that are available, charitable gifts potentially, that kind of stuff. And then, as Shannon mentioned, keeping an eye on estate planning. There's a bullseye on some of those. There's a bullseye on the back of some of those strategies that you guys use, Shannon.
Yeah, and I think this kind of goes to some of the things that are in the crosshairs, and they probably will be for quite a while because, as we now have kind of an unprecedented level of deficit of debt, and also just kind of looking to change the calculus. I think the political winds are changing in terms of reducing, doing redistribution. So things that you feel like maybe you would want to do, but it's just better to do them, I think, sooner rather than later. If it are things you're considering, like doing like a grad or something like that, like that's things that may be eliminated, that they may be eliminated 2 years from now, so even if they're not included in this bill, they're things that have a target on them. So you just want to be aware. And I think one of the general strategies here is if you think the tax rates are going up, then you want to kind of defer deductions. And or the tax rates are going up, you want to defer deductions, accelerate income. So take advantage of the lower income tax rates now. If you feel like capital gains tax or your ordinary income tax is going to go up later, then there are things that you kind of you want to do now to make your position better in the future. And we have somebody who's been waiting with their hand up patiently that I want to allow to ask their question. Chang, do you want to ask your question?
Maybe the hand went down.
Maybe he already asked his question in the chat.
But there is another question here.
Yes.
I've recently avoided Roth because we expect to retire outside New York City, but within New York State in about 20 years. I'd expect our income to go down then, but I was furloughed a whole year, so our income was significantly reduced. Could it financially make sense to do a big Roth conversion now? I'm thinking no, because we pay New York City tax now, but not after retirement. Although income is reduced now, it's likely to be somewhat higher. It's still likely somewhat higher than after retirement. Yeah, this is a great question, and there isn't an easy answer to it. I think we need to, there's a question of, what does your total tax situation look like now? What does it look like later when we're in the withdrawal phase? And when I think about tax planning, I really like to think about smoothing out your income over time. And so when there's lumps, when your income is too high, that's something that drives your income up really high in one year, or something that causes your income to go really low in certain years, that's where there are inefficiencies in a long-term tax situation. And so, John, I don't have an answer to your question. I don't know enough about your situation, but what we want to do is watch out for peaks and valleys in your tax situation over time. And sometimes when there's those valleys, look to fill up some of the lower tax brackets. And when there's peaks, we look at what are deductions, what are things we can do to offset the fact that you have a uniquely high income year. And so geographic arbitrage is something to keep in mind with the type of income that we have that can be somewhat moved around. That is a function of timing of where we live, like Roth conversions, like capital gains. Geographic arbitrage matters less when we have certain residency tax issues on ordinary income or on equity compensation that gets sourced back to a specific state. So, excuse me, not to get too technical there, but you're thinking about a lot of the right things, John, and want to ponder that.
Also, before we wrap up, a question about the child tax credit. So we have been talking about things that are affecting higher income taxpayers, and generally in this bill, if your income is under 400,000, they've really tried to not have you pay any additional money in taxes. But you are going to probably see some benefits. So the child tax credit, which was already in place, and they're looking to extend that John, can you tell us anything about that?
Yeah, and so the child tax credit is the original child tax credit we had for the last few years, $2,000 per child. And what they've done is they layered on that an additional $1,000 for all children, so it bumps up to $3,000, and then an additional $600 on top of that for children under the age of 6. Now, the income tax phase outs though are much lower on that additional 16 up to $1,600 than on the original 2000. The 2000 original one goes up to about 400,000 in income for a married couple, whereas the other two child pieces of the child tax credit are much more means tested in terms of when you can get them. But that's a big one. The other big one is the dependent care expenses, and that the amount of income available for a dependent care expense deduction, the amount of expenses that you can consider for that is now $16,000 if you have more than one child, and the credit is up to $8,000. Now, again, this is tied to income and can phase out at certain levels, but they have made, being mindful of the fact of how families have been impacted so dramatically by the COVID pandemic and childcare and working, and schools being closed and virtual setups and all that. They have really kind of taken a focus on some of these tax credits that impact working families, and so there are a variety of credits there, and you want to make sure you optimize them.
Great. Yeah. And that dependent care credit, that's basically for like childcare. That's
Exactly.
if you're,
Yeah. So childcare costs.
yeah. Okay, great. Okay, great. Well, I hope that this was helpful for everyone. And I put my email address in the chat. This disclaimer, it's not legal advice, investment advice. Talk to your accountant, your lawyer, financial advisor for all of those things. And please feel free to reach out to us if we can be helpful. My email address is shannon@mcnulty-law.com. And John, what is yours at BrooklynFI?
John@brooklynfi.com.
Very simple.
Easy enough.
Okay, great. Well, thanks everyone for joining us and participating. And we appreciate all of your questions, and stay tuned for more webinars and helpful information.
Thank you, Shannon.
Thanks, John.